We're seeing a lot of aspirational, wealthy individuals have enough. And they're deciding, well, you know what, the world's much bigger than the Australian borders. They don't want to get to the end of their days and feel like all they've done is work to just keep their head above water. So they're looking offshore.
Tech industry are saying, this is not good for founders. And my personal view is it affects every small business owner that started the business with a low capital base, which is the vast majority of it.
What's something wealthy people understand about money that most Australians never get taught?
Wealthy people see money as
you work to earn, you get taxed on that, then you go and use that and start trying to create more wealth and compound, create leverage. But then it seems that then that, of course, becomes fair game as well on money that you've already paid tax on. Even just making purchases. I mean, you go buy a car, you've got luxury car tax. If you go and purchase something, you've got GST.
It's analog rules in a digital world. We can't just go off on our own. And to the extent that Australia does go off on its own, you're putting other countries' noses out of joint, which may have far-reaching implications beyond tax. I think we punch above our weight, but ultimately, in terms of global powers, we're not. Labor introduced a federal income tax as a temporary measure 111 years ago.
As a temporary measure?
The top rate was 25%. If you were paying 25% if you earned 1.1 million,
no one would be complaining.
No one would care about tax.
What's the biggest difference between people who create wealth and people who spend their lives trying to chase it, but it always seems to be out of reach?
Good question. I'm kind of guilty of it myself.
My guest today is James Meli, founder of Mosaic Tax Legal and an Australian and international tax lawyer helping business owners, investors and companies navigate increasingly complex global economy. Now, before you switch off because you heard the words tax lawyer, this conversation isn't about tax returns. What fascinated me about James is that he spends his life helping people solve problems most of us never even see. As business expands across borders, technology changes how we work and the world becomes more connected than ever, James sits right at the intersection of business, wealth, risk, and opportunity. His journey started with a fascination for solving complex problems, but a major turning point came when he realized understanding Australian tax law was only half the picture. As businesses became more global, he saw that the old ways of thinking were no longer enough. Today, James helps business owners, investors, and entrepreneurs navigate an increasingly borderless world while protecting and growing what they've already built. We're talking wealth, opportunity, global business, financial freedom, and why complexity is often overrated, and what Australians need to understand if they want to get ahead in the next decade. James, welcome to the Freedom Formula podcast.
Oh, thank you. Happy to be here.
So for our guests that maybe this is the first time that they've heard of you, what is it that you've studied and done in the past that would give you the ability to speak of the subject of tax with such authority?
I am a tax lawyer and have been now, this is my 20th year. I started off at the ATO, was there for a few years before moving into private legal practice, kind of bounced between private legal practice and the advisory division of accounting firms before ultimately in 2020 moving out on my own.
The biggest issue on every Australian's mind right now is the most recent budget and all the changes that are sort of being rolled out still with capital gains. Perhaps walk us through what are some of the biggest changes that most Australians still don't fully understand that are being proposed.
In terms of what's being proposed, in a sense, it's going back to the past. We previously had indexation in relation to capital assets. It was more complicated to trace. Then it was simplified by just saying, look, as long as you hold the assets for 12 months, you can get a 50% capital gains tax discount. So it did simplify things. Now we're going back to indexation, but there's also different types of loss.
What's indexation? Just so
indexation is where you're essentially pegging your cost base to inflation. So over time, if you purchase something for $1 million and you held it for 10 years and there was 40% aggregate inflation over that period, you're taxed on the real quote unquote gain in the original inflation adjusted original dollars that you purchased the property for.
So what is actually being proposed that most Australians still don't really understand? Because there's a lot of talk.
Yes, and look, there is quite a lot of uncertainty in that it's quite unusual in the way that the legislation is being introduced, where the legislation essentially initially will tax everything. The Treasurer is going for various powers or discretions to be able to carve things out in the future. That in itself provides a bit of a vacuum in terms of how to restructure pending A, the introduction of that legislation, and B, the ultimate form of that legislation, which can be very different. It is a fundamental change, however, in terms of taxing income and capital at essentially the same rate, but for inflation, which I think is ideological in some sense. But as lawyers, as advisors, we can only really apply the legislation once it's introduced as it is. But it is a fundamental shift, something that has to be, once the legislation is introduced, catered for in terms of saying, okay, this is now where we are. What restructuring opportunities do we have? And they have flagged that there will be rollovers to be introduced. Those rollovers, in terms of to answer your question, in terms of what's kind of not really understood or not appreciated as much as it could be, is that they will apply from a federal tax perspective. We also have state-based taxes, most notably duty. So if we have certain jurisdictions that still tax or levy duty on changes in business assets, most notably Queensland and WA, for instance, or we have businesses or passive entities that may be restructured federally but have real property in them, then you're either going to have to speak to the states to say, let's align the rollovers. Otherwise, what works and is essentially tax neutral from a federal perspective will trigger duty at the state level. And as we all know, given real property is generally quite expensive, duty's a percentage of value, so that can be a very significant hit, even if you're not paying a cent federally. So that, I think, is something, I don't know whether it was thought out before, or they didn't really think of it at all.
Do you think they thought of it?
No, look, I don't know, but I just think my experience is even within tiers of government, they don't tend to speak to each other, let alone between tiers of government. So I don't think it was thought out at all in kind of releasing the budget.
The suggestion is that they're doing this so that the younger generation have a leg up and have an opportunity to get into the market and to win. Who is more likely to be a winner and a loser in this scenario?
Look, okay, I've got to try and not be try to focus on the law or the proposed law rather than the politics of it. But when you look at the aggregate, taxing or going back to taxing shares, I don't know how that has any implications for the housing market. Returning to indexation on shares, I understand originally it was proposed for property only. It was reported in the media that this may have been Treasury's idea to expand it to all assets. And look, from a tax policy perspective, kind of neutrality perspective, having the same rules for different asset classes makes sense in a vacuum. But if the entire point was to target a particular asset class, then there should be, in my view, a rule in relation to that particular asset class. But we see a lot of it in Australia, not just in a tax context, but certainly in a tax context, where rather than have highly targeted rules or perhaps policing the bad actors, there are just blanket rules. So this budget kind of is another kind of example of that, where rather than really targeting the problem as the government of the day perceives it, they'll just kind of throw the baby out with the bathwater, so to speak.
The problem was housing affordability, and they were trying to, I guess, curb that. What have you already seen as maybe a little bit of an initial reaction?
Mm-hmm. Oh, certainly there's been lots of inquiries about the possibility of restructuring, what alternatives there are in terms of restructuring. Ultimately, right now, as an advisor, we still don't have law. So until we get some clarity,
When do we have law? When does that happen?
once it goes through the parliamentary process, so it passed the lower house, there is a Senate inquiry which is going to pass its recommendations. That may result in some changes to the current bill. Then it's changed and it has to go through the process again. I have heard again in the media that the Greens aren't too keen on the Treasurer having very significant powers without being vetted by Parliament in terms of what is exempted in the future. So everything kind of right now depends on the politics, depends on the numbers before we get something that is law. And then we can say, okay, now we have basically the framework, the landscape as to what we're going to have to deal with going forward. And then we can start actually planning based on what is law.
What are some of the possibilities for restructuring? Because there's obviously perhaps two different types of individuals, those that are looking to get into the market and those that are already in. And it's mostly your mum and dad that are going to be impacted by this, mostly those individuals that have worked hard to get one property, maybe two, and at this point now starting to consider, well, what do I do now? But you've got two very different types of individuals. But for those that are on the other side of the fence, they've already purchased, they own, and should this pass and come into effect, I mean, what are some of the potential options?
The options for them, because of the grandfathering for the people who already own, that almost it creates a bias towards not selling, to my mind. If I had an investment property and I could negatively gear that forever as long as I own it, I might actually keep that for longer than I otherwise would, because I know that if I take profits on that property and put it into a new one, and I don't mean new as in new residential, which is essentially an exception to that negative gearing. Yes, just another purchase. If it was an existing new investment, then I won't get those negative gearing benefits. And
could it reduce supply then, given that people may, because of the grandfathering, choose to hold versus sell and swap and flip?
In that sense, yes. I think so. Treasury, I think they quoted a figure of about 35,000 less rental homes in relation to these measures.
They're quoting that there'd be 35,000 less available.
Yes, and it was in the paper recently. I can't remember which one, but basically said when you look at the numbers, you've got quite a few people selling already, and in terms of the buyers, less of those are investors. So that you could look at that two ways. You could say, well, there's more home owners, okay, plus that aligns with what Labor were intending in terms of, or assuming that they were first home buyers, but it also means that there's less rental stock because they've moved out of the rental market and into the ownership market. So, look, you always see disconnect between economic data and the modelling and interpretation. But when you look at Treasury's model, one of the things they mentioned is that this might make a $2 a week difference to rental income. I mean, anecdotally, already that seems to have been blown out of the water. And I know they're looking at aggregates and probably across the country. So I understand all that, but the modelling versus the real world particularly if you're someone in Sydney who renting in Sydney and your landlord's just said, well, your rent has gone up 100 or 150 or plus a week. The Treasury's models aren't going to mean much or provide much comfort.
They're not going to stack up. Is there anything else, I guess, that was significant in that budget that you feel is important to shed light on?
Well, certainly the rules around discretionary trusts, given that it's been
Maybe just explain discretionary trusts.
So discretionary trusts are an investment vehicle. They can hold any type of investment, really, whether it's an investment property, whether it's shares in a passive company, shares in a trading company. And they've been used for a long time, given they provide asset protection because, for instance, through that vehicle, you can control but not technically own the assets. And it also allows you, as the name suggests, it's discretionary in that none of the class of beneficiaries have any entitlement or fixed entitlement to a particular distribution. So from year to year, the trustee, which holds the assets and on behalf of the beneficiaries, can say, well, we made this much this year. I'd like to distribute 25% to this person, 75% to that person.
Can be flexible.
Yes, and the next year it can be completely different. So it provides a great deal of flexibility to kind of average down, particularly within a family group, the tax that would otherwise or potentially otherwise be taxed at the top marginal tax rate. Now, there are a bunch of tax rules that you can't have the tax distribution going one way and the cash distribution going another way. But again, that's more rules around targeted rules around bad actors, whereas this measure, it's kind of a sledgehammer to crack a walnut. And
nice analogy.
Yes. So essentially, what would often happen if a family didn't need all of the income of a trust for a particular year, they might park any excess or surplus trust income in a corporate beneficiary. The corporate beneficiary would pay tax, so that would generate franking credits, and you could pull that out via dividend at some stage in the future when they did want it. So they're saving the top up tax essentially in the interim, and that can, if it's reinvested in the company, could kind of compound over time. So that works. What is being proposed is essentially it kind of blows up your franking credits at a high level if you do that, which would obviously push up significantly the effective tax rate on income that is channeled through a corporate beneficiary. So in terms of what I think will happen, we mentioned before that the Labor did mention that there would be rollover relief introduced, which is beneficial.
What's the rollover relief?
Well, we don't exactly know, but ultimately they want to get to a position where perhaps you could restructure so that assets that are in a trust could move to a company. We do have some of those rollovers now, but how or what they're going to propose, maybe it's much simpler than the ones that are currently available, less hoops to jump through, for instance. And again, maybe after talking to the states, this particular federal rollover may attract, hopefully, state and territory duty-based rollovers to the extent necessary. But going forward, I mean, the low-hanging fruit in terms of like substituting out or restructuring away from corporate beneficiaries, I mean, you could interpose a parent company. So you could put a parent entity between the existing family trust and a current, say, trading company, for example. The trading company usually doesn't want to retain significant cash over and above its working capital requirements because that's available to creditors. You could pay a dividend up to the parent, so it's out of the hands of the trading company beyond the trade risk. And then that holding company could essentially invest in other assets at that level rather than pay a dividend out and have the surplus go to a bucket or a corporate beneficiary. So in that sense, the holding company can take the place of a corporate beneficiary, and at least in that scenario, rather than just getting rid of the trust altogether, you maintain the asset protection benefits of a discretionary trust, because it's easy enough to say, well, we'll just transfer the shares from a discretionary trust to mum and dad, for instance, and the trust is gone. But the problem with that, which is not tax driven at all, is that mum and or dad may be the directors of the company. Ordinarily, at least one of them are. And on that basis, there are circumstances, particularly with a trading company, where their assets are at risk. So if they have valuable shares in the company that operates the business, then they're putting those shares on the line. So it's really going forward having a look at the precise form.
Are these the changes you're now talking about? How they're sort of diluting the discretionary trust and sort of what it can do?
Yes, these conversations we're having in terms of what is potentially available, and then once the legislation is introduced in its final form, we can say, okay, of the various options, which we were hypothesizing based on what was actually implemented, this is what's actually introduced. Therefore, option 1 and 2 is the way to go, or option 1, whatever it happens to be. So right now, we don't have a lot of clarity, so we're talking about alternatives in the abstract. And then once we have some LAW to deal with, we can actually say, okay, this is, in your circumstances, this is the best way to go because.
One of the themes of this podcast is that the old rules don't necessarily work as they used to, right? As it is the freedom formula. Do you think Australians are still following a financial playbook that was built for a different era?
I do. When you think that a lot of people built their wealth in, if you're of a certain age, you may have a lot of pre-CGT assets, which again is something that the budget is getting rid of, in the sense that at a particular date, 2027, as is proposed, everything will enter the tax net, but based on its market value at the time. So it'll get a step up, but going forward, it's in the net. So if you're of a certain age and you were able to invest pre-CGT, that was a huge step up. Even investing years ago, and I know the classic, wages were lower back then, and obviously they were. But when you look at the average income to average house price years ago, around the 3 times, and now in Sydney it's 12, 13, 15, whatever it is.
Crazy numbers.
So it is a different environment, not so much in terms of people investing in new products like ETFs and those things, but just how much harder it is to get into the market. How much more your deposit has to be, the proliferation, and I see it day to day with parents who are in a position to help their children, doing so with, even a few years ago it was $100,000. Now it's $500,000, just in terms of gifts to the children in order for them to have enough so that A, they can get a loan, but B, they won't have a crippling mortgage. It's one thing to say, well, okay, we'll lower the requirements for a deposit, but that just really means a higher mortgage. So other things being equal,
golden handcuffs.
Yes, you've got higher interest rate sensitivity. So it's very hard. And look, I do accept that, just like my parents, they did live more frugally than certainly I do, or younger people do, who don't want to wait until they're 50 to go on a holiday or do this. I completely understand that as well. So I think it's a multitude of factors. Some are kind of systemic. Others are based on individual choices.
The business owner is one of the other, I suppose, small pockets of this conversation that have been impacted, right? We've touched a bit on just the average mum and dad, and they're more than likely to be employed and they've worked hard, they've invested into property. What about business owners that, for example, a lot of their net wealth is not just in property, but is now like in their business? Mm-hmm. How are some of these changes likely to impact them?
It's a great question, and it's a huge unknown, because as it currently stands, if you start a business, you might have $10 worth of share capital. Sometimes it's $2. And you can say, okay, well, what if you work hard for 2 decades and then you sell the business? It will ignore the small business capital gains tax concessions for the moment. But if you inflation adjust $10 over 20 years, even if it gets to $50, it's not going to move the needle at all. And if that gain is just taxed at someone's marginal tax rate, that's where you get all those memes about here's my co-investor 47%.
He got a bit upset about that, didn't he?
Yes, yeah. I mean, it's from a numbers perspective, it wasn't quite accurate, but certainly it was hyperbole. But the point being, right now, that is real in terms of, okay, inflation adjusting a nominal cost base is really not going to get you anywhere. There have been roundtables, the tech industry are saying, this is not good for founders and those types of things. My personal view is, great if you're a person in tech, but I don't see why tech is unique in that regard. It affects every small business owner that started the business with a low capital base, which is the vast majority of them. So right now we have the small business concessions, small business CGT concessions, which are one of the very few kind of free kicks in the legislation, subject to eligibility requirements. You can easily be pushed out of them. The thresholds introduced in 97 were originally 2 million in turnover or 5 million in net assets, and the 5 million has since been increased to 6 million, but the 2 million hasn't changed. And if you inflation adjust the 5 million, we'd be well above 6. So it is one of those things where if this is Labor's intergenerational equity kind of
play.
Yes, you do have people who 20 years ago, based on those same thresholds, were actually a lot wealthier, being eligible for those concessions, where without inflation, without adjusting for inflation, you have significantly less wealthy people now no longer qualifying. So that benefits the older generation rather than the current, even though the kind of premise of these property changes was to kind of reverse that. So they might be doing that in a property context, but they haven't been doing that in a business or small business context. So, and again, I know it's hard, but there is a lack of consistency there.
What do you think leads to the inconsistency, though?
I just think politics, really. I don't really think that it's by design. It's just they may have a political kind of focus on a particular asset class now, and if people aren't jumping up and down about it, it's like the squeaky wheel gets the grease.
You've worked with business owners ranging from local operators through to international businesses. What's the biggest difference between people who create wealth and people who spend their lives trying to chase it, but it always seems to be out of reach?
Good question. Look, I guess I'm kind of guilty of it myself. It seems that the ones that are able to take themselves off the tools, whether physically or at least even in terms of having some time to just think about the business and the direction, rather than just going kind of hammer and tong within it, that seems to be the
From
difference.
technician to operator, in that sort of roundabout way.
Mm-hmm.
Yeah.
Yeah, some people work so hard and they're super busy, but it's almost like they're on a treadmill, or they're treading water. Lots of activity, but no progress. Whereas those who can kind of connect the dots between what I'm doing today, or at each step today, kind of is towards that particular goal. So they A, have a goal,
Yep.
And B, that kind of informs everything that they do.
The changes are pretty significant. I mean, it's been one of. Would you say that the proposed changes are some of the most trying to maybe extreme in recent times? How would you describe it?
Well, yes, and you could say that that's because Labor have gone out on a limb, or you could just say most governments to date have really just tinkered at the edges rather than introduce any kind of significant reform. I mean, Shorten went to the electorate with it in 2019. We had the Henry review, so I don't think anyone doubts that tax reform is important. But in terms of what's being proposed, I mean, lots of people are up in arms because the way that it's been kind of introduced.
What do you think they're up in arms because of?
I don't think it's more. I don't think it's tax policy. I just think it's more. They see it from their perspective, and everyone is self-interested. Everyone, I understand that, but they say, well, I work. The progressive tax rates are up to 45 plus. There's Medicare levy on top of that, and if you don't have private health insurance, there's another surcharge. So rough. It's not, but say roughly half. Obviously, you have to earn over 190,000 to get there. But in years prior, that may have been a huge amount of money. It depends where in the country you live, but that isn't a huge amount of money to be basically in a position where they're taking half. You might be very wealthy at that income level in some parts of the country and kind of middle class in other parts of the country. And look, some people's response to that is well, you could move.
Which we'll touch on today.
Oh, okay. Well, yeah, whether you move overseas or move to a cheaper part of Australia, but yes. So I know it's hard, but most people are looking at it from the perspective, well, I work year to year, pay up to approximately half. If I choose to save that, then not only do I not get any discount, but when after working, saving to investing, and then when I sell that, half of it's gone again. So I think that's what's concerning people.
Yeah, I think it doesn't sit very well because how I look at it is, from how you've explained it is you work to earn, you get taxed on that, then you go and use that.
Yes.
And start trying to create more wealth and create leverage, as we've sort of touched on today about compounding wealth. But then it seems that that, of course, becomes fair game as well on money that you've already paid tax on.
Yes.
Even just making purchases. I mean, you go buy a car, you've got luxury car tax. If you go and purchase something, you've got GST, then everything else in and above that.
Yeah.
What's the likelihood that it could be possible? Because I did hear this as a suggested possibility with the current government, that they could introduce some kind of death tax, but putting lipstick on a pig, they call it something else.
Look, I don't know. I have heard some pundits in the media saying, well, if they can change their position on this, why couldn't they change their? That's right, and I think I haven't heard that that's a policy, but I think people are concerned given that there has been a change of position.
It's a convenient way to describe a backflip.
Yes, and politicians of every every ilk, they spin things to their favour. But the concern is, well, if you can change your view on this, you could change your view on anything. And the budget does have it talks about measures that were or decisions made but not yet announced. And I can't remember the exact figure, but I think it was about $15 billion. So it's not chump change. So does that suggest that there's big news coming separate to what is already known? So I think it's more from I haven't heard anything official in that regard, but there is that budget line item, and people are concerned that really, if you've changed your position, that you could do so on anything. So really, where does that leave us? Just at the mercy of any kind of decision. And again, to be fair, there are things where you can't really say, oh, that is entirely off the table, because the vicissitudes of life or government could force you to make a decision that you were against.
What could force
at the
them
time.
to do that? Increasing debt? What would force them to start to consider that? What about the family home at some point?
Well, that's another thing. But Australia
is that likely?
Likely, who knows? Likely,
it's plausible. It could happen.
It's possible, yes. And when you look around the world,
where does that happen around the world?
Australia is pretty unique in that we don't have death or estate taxes, and a lot of other countries do tax the family home. Of the major global well, in the United
powers.
States, for instance, last time I checked, I'm not a US advisor, but I understand that $250,000 per individual, so $500 for a couple, is exempt, and then the rest is taxable. But I also understand that your mortgage is deductible, so that's a different system. But again, it goes to the issue of targeting. The government could say, okay, you get so much tax-free, essentially like a tax-free threshold on your home, and the rest is taxable. But again, the way that Australia seems to operate, not just in tax but across the board, is you're all in or you're all out, rather than kind of targeted measures to say, well, if you make $20 million on a Vaucluse mansion and it was your home, it's completely tax-free. And it's the same if you made $500,000 somewhere else. So, I don't know whether they'll introduce it. I think it'll be politically
might be political suicide if they were to do that.
But if you
would it be fair to say that a lot of the current focus has been around wealth redistribution, right? That's kind of been the focus of it, trying to make it, I suppose, easier for some to get on a level playing field. Mm-hmm. This has kind of been the idea, right? The big issue seems to be that we're not focusing on some of the ways in which companies are actually operating in Australia, big corporates that actually obviously don't belong to Australia, but they operate in Australia. And we're talking about the Amazons, the Googles of the world, Apple, and these entities have offshore structures and setups. They come and do business here, and they pay very little tax, for example. Right? So if it's about wealth distribution because we have rising debt, right, as a nation, we've got to pay that back. And they're trying to, it's not just about housing, but it's obviously also about other things also, right?
Yes.
So what would you say to that where, for example, you've got two obvious things in front of you. One, you've got the issue of housing, but other is big corporate who are doing an incredible amount of money in this country but actually not paying their dues. What should be the focus?
Yeah. Well, the problem with exactly what you were talking about in terms of the big multinationals having subsidiaries here in Australia is that to a large extent, the international kind of tax framework was introduced between World War I and World War II. So we're really stuck with analog rules in a digital world. So if you have the secret sauce developed offshore and an Australian subsidiary that is using that secret sauce to make sales here in Australia, and under what is called transfer pricing, it is required to pay its related party offshore for that secret sauce, and it has to pay at arm's length, then that is an easy way to pull profits out of Australia. Now, Australia has limited capacity to kind of unilaterally, if it's made a bunch of bilateral agreements with all these other countries, it's a member of the OECD, which has commentary as to how particular clauses or the entire kind of base template for a double tax agreement is to be interpreted. There's limited scope to kind of go off on a frolic of its own. There have been, in recent years, the ATO have put out a ruling on what they consider as royalty. And they've kind of received correspondence from the US. Treasury just saying, essentially, we've signed up to this agreement. You should be abiding to the letter and the spirit of kind of what everyone has agreed. So in that instance, particularly when it's binary, because most multinationals are American, and a dollar that's taxed here is a dollar that's not taxed there, and the fact that they did try or have tried at the international level to introduce what they call a multilateral instrument. So rather than renegotiating hundreds of thousands of double tax agreements, basically having the two countries sign on to agreed changes, which just adds another layer of complexity. But the point being, it's analog rules in a digital world. We can't just go off on our own, and to the extent that Australia does go off on its own, you're putting other countries' noses out of joint, which may have far-reaching implications beyond tax. In terms of general politics, do they start making waves in other areas and leveraging their power? Australia, where I think we punch above our weight, but ultimately, in terms of global powers, we're not one.
We're not one of them.
Yes.
So, I hear there's not really that much that then we could do to sort of recoup some of that. And
there are certain things we can do in terms of striking better commercial deals with our resources and those types of things. I saw in the paper not long ago that Japan makes more money from our gas than we do. I don't know whether that's true, but that was what was Why
reported. Would that not surprise me?
Yeah, I don't know. So I don't even know what the issues are there. Is it our lack of negotiation skills or foresight beyond the particular 3 or 4 year election cycle? If you're signing a 20-year, 30-year deal, do they just want a quick win saying, oh, we made a big deal? Or are they actually thinking, okay, by year 10, this is going to be a terrible deal? So I don't know. But certainly it seems that we could be doing better in that regard.
Quick pause. If you're listening right now and you weren't... Where does Australia then, in your mind, stack up in terms of fairness? I think that's really the thing on the mind of a lot of Australians and people that I talk to consistently, and what I hear, what I see on socials. We pride ourselves on being a type of people that treat each other fairly, and I think there's this kind of undertone, this feeling right now that Australians share across the board generally, that we're being treated quite unfairly in terms of how we're being taxed. I mean, where does Australia sit, do you think, in terms of the if there was a way to measure up against other global powers?
That's, it's a good question. Because
that'd be a general way of trying to figure out where we actually.
Yeah. If you look at it in tax in a vacuum, the US, for instance, the top federal rate is 39. It kicks in terms of AUD, it's like $1 million or something. So the US does have a lot of state taxes, though not every state, but lots of them. So that's added. Some even have city-based taxes. So it's hard to do a direct comparison. I think, and again, it's across the board. Most people, I don't think, would have a problem with the rates. Personally, I think anything approaching 50% is too much.
Outrageous.
And I have a story in a second after we get this. But obviously, we want to live in a good country. Just like you with your business, if someone complains about a bill, usually it's not the figure, it's their perceived value. So I think, lots of people looking at paying all of this, looking at the country and thinking, I'm not getting value. The hospitals, and everyone says, we have great hospitals, but if you actually go to a hospital, do you have a good experience? It may be comparatively to other countries, but that's relative, not kind of objective. To go to that original story, I was just playing around with AI not too long ago, so take this with a grain of salt. But it said that Labor introduced a federal income tax as a temporary measure 111 years ago.
As a temporary measure?
A temporary measure.
How temporary are we talking?
Yeah, exactly. But it was apparently...
And that was Labor that did that?
Labor. Well, according to AI, I didn't fact check it with, but it did say that the top rate was 25%, and it kicked in at, I think, 7,300 or 7,600 pounds. And then I said to AI, or asked AI, if you convert that for, went from pounds to dollars, and for inflation, what is that today? And it said 1.1 million. So I think if you're paying 25%, if you earn 1.1 million, I could be out of a job. No one would care about tax. Yeah. But what we have now, it seems across the board, we pay a significant amount in income tax, and that's just one of many, many taxes and excise and duties and all of those things. So, if you think about it in terms of the total kind of tax cost, it will be huge. And I think people kind of see or perceive that, I went to university, or I got a trade, I work hard, I started a business, or I'm in a good job. And if they perceive themselves as treading water or working harder and going backwards, and again, that could just be their subjective kind of perception rather than reality. But I think that seems to be an issue.
I think the morale of the people is one of the things you want to protect more than anything. When they start to feel like, despite their efforts, things are going backwards for them.
Yes,
that's where they start to lose hope. And when someone loses hope, then you have a problem.
Yes, yeah, and then people get angry, and what's
the real tax rate? So we touched on it earlier, where you defined it a particular way. I can't quite recall how you defined it, but you've got your income tax, but then you've got all the additional things that you actually do pay. So if you were to, is there a way?
Oh, look, I'm sure there is, but that would be for an economist, not a simple lawyer. But it would be massive because.
What are we looking at? Maybe more like 60 to 70% of our total income.
If you said, all right, the average rate of income tax, not the marginal tax rate, even if it was 30, or then you've got GST. I know we have GST free items, but GST on most things, and then there's excise in petrol. There's taxes in booze,
cigarettes, alcohol, sporting events,
registration,
entertainment,
everything. So the total tax take would be massive. You think, and I know that there are tax-free thresholds from a land tax perspective, and this is a state issue, not federal, but unless you're exempted, they get 1.6% of the value of land every single year. And that feeds into rents. Commercial rents are usually X plus outgoings. So the landlord might not even increase the rent at all, but the rent could go up significantly based on increases in valuation. And I see comments on online articles all the time saying, well, you could just increase prices or what have you, but I don't think that's someone who's been in business, because you might be able to increase so much, your margin is squeezed, but ultimately if you just passed on everything, you probably wouldn't have a business for much longer.
There's a point where you really can't continue to pass it on all the time.
That's
in
right.
every scenario, particularly.
That's right.
Sometimes you've got to eat the cost.
Yes.
Particularly business owners now with perhaps how difficult things are with the cost of living and an additional layer of pressure. I suppose on another note...
Sorry to interrupt.
Yeah.
When the excise reduction comes off at the end of the month, and then we're paying another 40 cents a litre in petrol, and then all of the... everything runs on diesel. So
how is it justifiable that then... What is it, about 30-odd% of our fuel price is in tax?
Mm-hmm.
Wow.
In terms of,
yeah.
whether it's justifiable, it's revenue.
Okay. So with I suppose a new, it's not really a new trend, but I guess it's maybe just more popular, more common. We're seeing a lot of aspirational, wealthy individuals have enough, and they're deciding, well, you know what, the world's much bigger than the Australian borders, and they're looking offshore. They're looking at options, right?
Yes.
They're well versed. They know what they want, lifestyle. They want to keep more what they earn. They want the risk they take when they're working and building businesses to usually mean they get a bigger piece of the pie at the end. They don't want to get to the end of their days and feel like all they've done is work to just keep their head above water.
Yes.
And so they're looking offshore. Have you seen a big increase in this type of activity and demand for tax residency?
Yeah, in terms of inquiries, this was a phenomenon before the budget, and it's not explicitly tax driven, but lots of Australians just saying, look, from a lifestyle.
Who's the general person? Like, who's the if you were to sort of classify who this type of person is, who are they? One or two types of people.
Yeah, generally younger people, 20s, 30s, kids, no kids, couples, so digital workers or digital entrepreneurs who are looking overseas versus Australia and see, proximity to the rest of the world, being closer. Yes, they might say, oh, look, this country has this particular regime or incentive or deal, and we're not just talking about tax-free jurisdictions. It's a mixed bag. Singapore, Serbia, I mentioned before, Georgia, the country, not the US state. So they're looking at the same thing. Their lifestyle factors as a whole. Tax is part of that, just in terms of funding what they think is a better lifestyle, and the experience of just being somewhere else. A different culture, a different way of living.
What are some of the things for someone to consider then, if I've already explored that and they're in that sort of stage of contemplation? What would be maybe your, let's call it top 5 to top 10 points of consideration before pulling the trigger and actually moving forward on that?
They are the ones that decide where to go based on
location
and why. That is really a matter for them. I deal with what happens before they leave and the implications of leaving, and if they have anything in Australia ongoing, how the Australian system is going to interact with the foreign system. So essentially, Australia does have an exit tax.
It has an exit tax.
Yes.
They charge you on the way out.
They charge you on the way out for certain types of assets. There are certain assets.
Is that for taking your money with you?
No, it's more to capture certain unrealised gains at the gate, because once you become a non-resident, that asset would no longer be taxable. So they have to get you at the gate, otherwise they can't get it at all. So Australian property and certain indirect interest in Australian real property is always going to be taxed here. So they don't need to get you at the gate, because even if I was a foreign person and I had a house in Sydney, I'm always going to be taxed on that. Whereas if I'm an Aussie, I am an Aussie, but and I own a portfolio of CBA shares, and I bought them for $1 million and they're worth $2 million. If I left and they didn't tax me on that $1 million, then the second I become a foreign resident, they can't tax me on the capital gain, because foreigners aren't subject to tax
so it'd be too
on
late.
Capital gains. Too late. Now, as an individual, unlike changes of residence for companies or trusts, I can say to the ATO, don't tax me now, tax me when I actually sell. Which sounds good, and it is. Generally, you'd rather pay tax later than sooner. But if you take that route, and it applies to all of the assets, you can't say, I'm up on this one, so defer it. I'm down on this one, so I'll trigger it. It's kind of one in, all in. In terms of me exiting, if I make the exit election, don't tax me now. When I eventually sell, then I have to return that gain here, and being as though I wasn't an Australian resident for the entire time, I no longer get the full discount, 50% discount, even though the budget's affecting that anyway. And I'll pay tax at non-resident rates in that year. So, at a high level, you can defer, which sounds good, but then you'll be paying more tax later. Mm-hmm. So that's the rub, so to speak. And structurally, why they have an exit tax is for that reason, because foreign investors aren't subject to tax on Australian shares unless there's certain indirect Australian real property interests. So they need to get you before
on the way
you're
out.
Gone.
Yeah. So what are some of the things then? So we talked about location. What are some of the other things that need to be considered before?
Whether they're going to cease to be a resident. That's the biggest issue.
So to be clear, would it mean that you have to give up your citizenship?
No, there's overlapping kind of tests. There's a resident for tax purposes. There's a resident for visa purposes. There's a resident for social security purposes. What we're talking about here is tax residence. Now, a lot of that we have 4 residence tests. So ordinary residence, the domicile test, the 183-day test, and the Commonwealth Super Test. If you satisfy any of those 4, you're an Aussie for Australian tax purposes. Now, some of those, because they're fact-based analyses, your immigration status may be relevant to that. If I was working in Saudi Arabia on a temporary work visa and I was living in kind of work supplied housing. That's a very different scenario to me, living in, I don't know, in Cyprus with my family and a house and living and working there and having a permanent residency visa. So it's qualitative and quantitative. So when someone says, I want to leave, analysing based on how they're expecting to live, their movements, are they going to be putting down roots in another country, or are they going to be a bit of a nomad?
Most people want to be a little bit flexible in their...
Yeah, flexible is fine, but if because we have the domicile test, which is essentially if you have an Australian domicile, born here, for instance, and you keep on moving around, you don't have what is called a permanent place of abode overseas because you are moving around, then it's not that you default to Australia. You kind of, but ultimately, if you're moving around for 20 years, it might be a different story. But essentially, the ATO can argue that, well, you never really had any place of permanent residence overseas, so your domicile being Australia, you remain an Australian tax resident. Now, that means whatever you earn overseas is also taxable here. Yes, you generally get a foreign tax credit for what you paid overseas, but obviously it means that you've got a residual liability here in Australia, which can be very, very significant depending on where you are. So it's also very highly relevant where you're actually moving, because if you're moving to a country with which Australia has no double tax agreement, then the Australian rules can apply.
What are the examples of some of those countries?
Hong Kong is one, even though we have a double tax agreement with China, but not with Hong Kong specifically. We have double tax agreement with Singapore, lots of our larger major trading partners. But in terms of, we don't have one with the Emirates, for instance.
So that would mean that someone that would end up in a country like that and set up permanent, let's call it tax residency, could possibly be double taxed.
Potentially, yes, because we're the beauty, I guess, of a double tax agreement is relative certainty, because generally they operate to say that if you fall into the definition of a residence of two countries, Australia and the other country, I should say, and they've entered into a double tax agreement, there is what they call a tiebreaker rule. And generally, the first tiebreaker rule is where you have a permanent home. So if you're living and working overseas, you fall under their domestic definition of a resident, you have a home there, and you don't have a home here, or even if you have a home, it's leased out to a third party, so it's not just available to you here in Australia, then the double tax agreement will say you're only a resident for the purposes of the double tax agreement in the other country. So Australia's kind of agreed in those circumstances to give up its taxing rights by virtue of residence. Obviously, if you've got income being generated here, it might be taxed on a source basis. But that's much clearer than if you've got Australia and another country where they don't have a double tax agreement, because Australia's domestic rules will apply on their face. There's no kind of pre-approved out as there is with a double tax agreement if you satisfy the relevant criteria. So it's much more grey.
They've got to have a permanent location where they've actually set their roots in. Even if they're not there all the time, they have to be
they can go on holidays and all of those things. It's just that if they're kind of nomadic in the sense that, I might spend 3 months in Portugal and then Spain and then Cyprus and then back to Spain and then off to Morocco, whatever it is, then you're going to have domicile test issues.
So with that in mind then, what are some aspects of what Australians need to be aware of and considerate of? Because I'm sure, what's the worst case scenario then? I'm sure you've seen cases where people have made a decision to move, perhaps even had some advice, maybe not so good, and then it plays out badly. What are some examples of that?
I've only seen issues with people coming back quite soon. So something has gone awry, and they were intending to go overseas permanently or indefinitely, but something happened, so they ended up back in Australia in a couple of years. That's not so much an issue with the law. It's just more a matter of evidence. So, with the tax office, the burden of proof is on taxpayers to prove to their satisfaction that you were intending to leave permanently or indefinitely, and something happened.
So that would include selling assets, renting them off.
Yeah, if you're selling assets, closing down, bank accounts, what you do in terms of your address on the electoral roll, what you tick when you are on the plane leaving, a lot of those things really these days shouldn't have much weight. But the tax office and taxpayers, they'll attribute different weight to things if it suits them. I mean, the tax office do it, but taxpayers do it as well. But really, you have to look at everything holistically and say, look, on balance, I was intending to move overseas, and I got sick. I broke my leg, or it was going to be $50,000 to go to the hospital over there, so I flew home, or whatever it happens to be.
What are the most popular countries you're seeing people choose? Because it's like a buffet, right? I mean,
Well, that's
when you think
right,
about it. But so what are the maybe top 5 you're seeing most common?
Lots of people go to Thailand and Indonesia.
Status quo.
Yes, lots of people go to Singapore because it's very, very stable, very safe. People go there for their kids' education. So this is not by any means a tax issue. Singapore has a double tax agreement. They're halfway to Europe already. Lots of people who Asian background, not necessarily Singaporean. That's a good hub. I've seen they enjoy the culture, and they say, look, other than housing, and if you want a car, it's actually not bad in terms of the cost of living. So Singapore's very popular as well, but it's a mixed bag.
What about in Europe? What are some countries that you've seen have a good setup, that quite favourable, and lifestyle is good, and people are choosing to go there?
The ones that I've seen go to countries like Croatia, Serbia, Cyprus, they tend to have, whether the husband or the wife or both of them, some connection. Whereas, the ones that go to like Southeast Asia, tend to have no connection. It's just, I guess it's closer, it's more familiar to an Aussie. Whereas the ones that move to Europe, because lots of European countries, they have a lot of the same kind of issues that they're looking to get away from. Packed cities, and they're looking to get away from the rat race. So it doesn't tend to be, no one's moving to, I'm sure some people are, but in this context, people aren't moving to London or New York.
That's probably the last place they go into.
Yes.
Everything I hear about is that London, and the UK in general is probably in a far worse state than what Australia is, really.
Mm. Oh, yeah, potentially. I don't know, but I did read not too long ago that their welfare bill was more than their tax take. So I don't know how sustainable.
So how sustainable is that?
How sustainable that is.
Australia isn't that much of a different situation, though, really, is it?
I've never actually had a look at the numbers. Of course, psychologically, $1 trillion debt seems huge. What I don't know or haven't had a look at is, if I bring that back to me and a mortgage, if I say, all right, that's actually 15% of my annual income, that's not crazy, because usually the house, a mortgage is a multiple of your income. So not to say that $1 trillion is great by any means, but I just don't know how good or bad it actually is based on our GDP. I'll check it out. But
and so I guess From your perspective, has Australia become harder or easier to build wealth in over the last decade?
I think it's harder, and it's structural in terms of asset price inflation, but that's around the world. Whether it's because of all the money that was kind of printed during COVID, who knows? But obviously, more money in the system kind of inflates asset prices, and we've certainly seen inflation of asset prices.
Yeah, and what's something wealthy people understand about money that most Australians never get taught?
Good question. I did read something not long ago that wealthy people see money as a medium to make money, not as a medium to pay bills or to buy things. So, yeah, maybe that's true. I certainly think that my wife is a teacher, for instance. So no disrespect to her, but I feel myself, school didn't really prepare you for life. And I think if anything, given the way that the world has moved, if anything, it's worse now in terms of the skills you'll need in the future to be able to get anywhere. So, financial literacy, not just kind of computer literacy, but the 4-year degree, is that dead? What you should be focusing on in terms of interchangeable skills, or almost like a utility to be able to plug into the fact that you'll probably have different roles and different careers as things change, and that industry kind of dies away and a new industry pops up, but is there a continuity of skills that they need?
I love the idea of that. I think it's more relevant than ever. Perhaps when our parents were going through school, it was more common to think of a skill and stay in your lane, do that, become a master at it, whether it's blue collar or white collar. I do feel like that's changed, given perhaps just the opportunities ahead of us, but what you need to actually be a master of in order to succeed. Yeah, I think about business owners. I mean, you must say this all the time. I mean, they've got to be good at their trade or their thing, what they deliver, their product, but then they have to be a master at so many things. One of those things is money, is understanding their P&L, what their responsibilities are with tax and how to adjust for inflation. Most business owners, funny enough, actually don't ever adjust for inflation.
Yes.
They don't factor that into their pricing in a way that's periodic and planned and then creates a sustainable margin for them.
Yes. Most of my referrers are accountants, and just having conversations with them, there's lots of zero add-ons and other. I'm sure there are with other software programs, but this one was about zero. And they said they were surprised at how many of their own clients would or started out very low volumes in terms of buying from their own suppliers. Now doing very well, purchasing significantly more, and never even broached the topic of a volume discount. Which would make a huge difference to their margin. Super basic. But it goes to the issue we kind of touched on at the outset. They're so focused on the working in the business day to day that they never are detached enough to say, hey, why don't I have a conversation about this?
So how would you describe what it is that you stand for?
Okay. I guess knowledge and knowing what you're entitled to in terms of day to day. Again, I said before, there's very few free kicks in the legislation. So if they're there, by all means, like the small business concessions, take full advantage of them if you qualify. It's more about using the legislation to keep as much as you possibly can without getting into any trouble. I mean, if you've spent your life building something, you don't want to do something that kind of jeopardizes everything that you've built.
And then on the flip side of that, what is it you fight against?
Look, in terms of who I deal with every day, the ATO, revenue authorities, obviously they have a lot of work to do. Sometimes they make good decisions, sometimes they don't make good decisions, and it's just about helping your client, making sure they get what they're entitled to, making sure that a particular interpretation from one of the revenue authorities is in accordance with the law, and kind of enforcing some measure of accountability that way. But that certainly is the most satisfying in terms of helping people get to the right result, being that the result that's available to them under the legislation, which is what Parliament intended.
Make sure they don't miss out, basically.
Yes.
They get what should be coming their way.
That's right. What Parliament intended for them to have.
One last question, and I think we touched on this before we got on the show, but we haven't actually addressed it, which is hypothetically, I mean, it seems the most likely next step is that the, I suppose, proposals get through with the budget. Mm-hmm. Should they be voted out?
Yep.
How possible is it that what is, I guess, about to be put into place could be reversed?
Well, it's definitely possible. I think both Liberals and I think One Nation said that they would.
They've come out quite strongly saying that they would.
Yeah. I mean, logistically, it presents a problem in that everything you do to plan for the measures introduced by Labor will have to be undone. So you might have to restructure again, but back to the past. So it has its own issues, but yes, if they have the numbers, they've both committed to it. Unless they change their mind, then yeah, it's very, very possible. It's only the only downside is having to logistically deal with that reversal.
But very likely to get them voted in.
Well, who knows? It's, the more I look into it in terms of preference flows, it's definitely
it's a hot topic.
Yeah.
I'd probably say it's the number one thing that I see people getting their pitchforks out for right now.
Yes, yeah. I mean, it's one of those things where either way, if something swings too far one way, then you would expect
it tends to counterbalance.
Yeah, but over time. So you might be in this period where a lot of people perceive that it's too much this way and it's too much that way, and then there's a reaction. The problem is it just seems that we're always overcorrecting.
If there was a closing statement you could give to Australians just about the way they're looking at their future, given what they faced on a day-to-day with tax, what would you say?
I think it definitely means being kind of more strategic, perhaps more disciplined. And if you're going to stay here and you aren't, going to move overseas, then this is the environment that you've kind of chosen to remain in. So within that framework, you have to kind of determine what you need to do to get to where you're going, and
learn
that
how to
may
win.
mean that it's slower because you're compounding from a lower net amount per year. But does that mean you have to work longer? Does it perhaps you don't want to take higher risks with an average higher average annual return, which is more kind of a financial thing than certainly a legal thing. But it just means I think you have to be more strategic about what you're doing.
Thank you, James.
Thank you.